Welcome, welcome, welcome. Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser. So excited to be with you guys. Getting to the end of the year here and wanted to get an end of the year sort of checklist out to you. Video format, keep it like under 15 minutes, get you some tips for the end of the year, because I have been involved in it with my clients. And although I can't give you direct tax advice unless you become a client, I'm happy to give some generalized information on the podcast for what we're doing with our clients at the end of this 2021 year, which is a crazy year. So I want to talk first thing off the top of my head from some of the largest tax tips that people miss out on, because they're usually at the end of the checklist, and I think they're the most relevant. So the first thing is if you have an RMD that you have not already taken, obviously make sure you take it, because the penalty for the RMD that is not taken is 50%. So what do I mean? If you have a $25,000 RMD, then your penalty is 50% of $25,000 if you do not take your RMD. So you want to make sure that you take your RMDs by the end of this year, December 31st. But one thing you can do is a qualified charitable deduction, basically a QCD. So instead of an RMD, which is acquired minimum distribution, we basically make a qualified charitable deduction or distribution directly to the charity. So you simply call up your plan administrator. So let's say you have an IRA with Fidelity. You simply call up Fidelity and you say, instead of sending the RMD to me, I want you to send it instead to Metropolitan Ministries. That's my local charity that is a food bank, and I want to give to that for the holidays. And they will write your RMD directly to Metropolitan Ministries. What that does is allow you to avoid that income while yet still taking your required minimum distribution. So it satisfies the RMD requirement, but it puts it right directly to the charity. So your charity gets the income. Of course, they don't pay taxes on income because they're a charity. So they will recognize it. You will not recognize it, other than the fact that you in fact did take your RMD as required per IRS rules on a yearly basis. So the first thing is direct your RMD that you don't need to a charity from your custodian directly, and avoid taking that as income. You do not get a deduction because it cannot be a double whammy. There is a double whammy coming up though. That's coming next. But I just want to be clear on the RMD. You don't get to not claim the income and then take it as a deduction. So if again, I had a $25,000 RMD required and I had the RMD done as a QCD and I sent it directly to the charity, I will not get a $25,000 deduction to charity because I didn't recognize the $25,000 of income. It never came to me. I never accepted receipt of it. Therefore, I don't have it as income. And therefore, I don't have that as income, but I don't also get the deduction because I never acknowledged or realized the income. The double whammy that I have for you, that is where you get a double deduction, is appreciated stock or property. And most people don't donate real estate. That is a place that you could right now in this country get a double whammy. But what I talk about a double whammy is we want to get a tax benefit without a tax cost. So what do I mean? So let's say that, I have a lot of clients that are taking advantage of this particular strategy this year. So let's say that I have appreciated stock, and my stock cost me $500,000, but it has grown to $1 million. So I have a $500,000 built-in capital gain because I've had the stock for over a year. Now, normally, if I were to donate property to charity, I would get the fair market value of the property donated, and I would be able to write that off. Well, when I donate appreciated stock, I am able to write off the fair market value. But remember, I only paid $500,000 for my $1 million. So I get to take a charitable deduction for I'm assuming we're talking in general as if I'm donating the whole thing. If I donated $1 million to charity, even though my cost basis is only $500,000, I get to write off the full fair market value of that donation, subject to limits, which we'll talk about in a second. But I get to write off that full $1 million, even though I never was taxed on that appreciated gain of $500,000. So I have a double whammy. I avoid paying the capital gains tax altogether, and I get to fully write off the fair market value of my appreciated stock that is donated. Now, the limits are there. So you're not able to take more than 30% of adjusted gross income on property that's appreciated. So if I donate property that's appreciated, whether it's real estate, land, or stocks, actual investments, what I donate, I can only write off 30% of that, up to 30% of that in appreciated property of AGI. So let's say that my adjusted gross income, this is getting really technical now, I'm sorry, you guys, but let's just say that my adjusted gross income is $100,000. I'm only able, when appreciated property, to write off up to 30% of my AGI. If I'm donating cash, I'm able to deduct up to 60% of my salary. So if I was to donate cash and my staff was $100,000, my salary was $100,000, we would be able to deduct up to 60% of that. So let me just step back out of these weeds for a second. This is why nobody tries to ever explain anything, because it's so complicated. Let me just step back for 1 second and tell you, we've just recovered two ways to take taxable deductions. The first we talked about is in lieu of taking the RMD, sending the RMD through the QCD process from your custodian directly to your charity and never recognizing that as income. You can do that, a QCD. The second thing that you can do is you can donate to a charitable organization, a 501c3, a donor advised fund. You can do these kinds of advanced planning techniques. You can do appreciated property that allows you to get a full fair market value deduction on the charitable side, yet not have recognized the long-term capital gain. So donating appreciated property allows you to get a double tax whammy. It is legal, but it only allows you to do that up to 30% of your total adjusted gross income, your AGI. If you're, however, donating cash, you can deduct up to 60% of your adjusted gross income through those methods. So that's the first two tips. The next tip I will give you is make sure that you do tax loss harvest. While we look at market down days as bad news, sometimes they provide the time frame for us to capture those losses and shield some other gains. So obviously last year, the market had a substantial correction after Corona with all the stimulus, and this year the market has done the same. And so you could leverage some of your losses that you might have locked in on downside days if you are sold out on down days. You could harvest any losses if you have any. You might not have any, and then you could take those. Obviously, always take those against gains. So people talk about tax loss harvesting all the time. All this is your advisor going through and seeing any losses that are inherent that haven't been realized, deciding we don't like those positions anymore. Let's sell out of those positions, harvest the loss to offset the gains we've had in other positions that we've sold where we've had gains. So that's tax loss harvesting for you. The other thing that I really think that everyone needs to do, besides a QCD, a qualified charitable distribution, is, and charitable deductions, is you need to come up with a budget. And the other thing you need to do is really assess your Roth conversion opportunities. So a lot of people have worked with their CPAs for 20, 30 years, and they heard conventional wisdom and they followed conventional wisdom for the, most of their career, which was they maximized their pre-tax wealth building and they minimized or never leveraged the Roth. The Roth literally has been on the scene in corporate America since 2006. So it's only been not even 20 years yet that it's really come out into the corporate world where it was corporately available. So it's very rare, although the last 3 years I've seen an explosion of Roth 401ks. And so what I would say to you is if you're still working, look this year at the start of the new year, look to see if the Roth 401k is an option and definitely consider no longer tax deferring. I can't think as a tax attorney of any circumstances in 2021 that still makes sense for us to continue to defer. We defer based on the conventional advice and wisdom that said, hey, don't pay the taxes now in your working years while you're making the most you'll ever make because you'll put yourself into higher brackets. Instead, defer that money. Don't pay the tax. When you retire, you'll be making less. And so therefore, when you take that money out, it will be at a lower bracket. And that's the conventional wisdom that everyone's been following for the last 30 years. What people did not say is that equation, in order for that equation to work, tax rates have to stay the same and they have to be flat throughout your lifetime. If taxes actually go up, and so we have a rising tax environment versus when you were working, you actually could be paying more in retirement than you could have paid potentially right now. For example, The 401k was written in 1978. It came into prominence and use in 1981. Ronald Reagan cut taxes effective 86 and went into effect in 87. So 6 years after the 401k really came into prominence, we cut our top tax rate from 70 down to our top tax rate was 28%. So since 1987, we've been living in almost 40 years, almost 4 decades of really low tax policy, yet we've been deferring, waiting for us all to retire to be in a lower tax bracket. As you guys know, if you've watched my program many times, the baby boomer retirement that is happening now in earnest of the 65 million boomers that are still retiring, that are still working, that's going to be completed predominantly by 2028, and taxes have nowhere to go but up. You really need to look at the Congressional Budget Office analysis that was done in 2008 that lets us know where middle-class tax rates are going to be. We're going to be Europe. Middle-class tax rates are going to be 40 to 60% based on the amount of baby boomers that we have. So really, seriously, consider starting to contribute for 2022 to a Roth instead of the traditional 401k. And then if you already have contributed to the traditional 401k, I would highly, I cannot highly recommend this anymore. I would highly recommend that you look into a Roth conversion strategy. That's something that we do at our practice is we assess how fast and how quick to get a Roth conversion strategy done. You want to get a Roth conversion strategy in place. And the other thing that you want to do is you want to make sure that you also potentially look at an insurance tool as an additional leverage tool for additional tax-free income. Especially, and I'll end up with this last and final topic that we have here, always make sure that you've backed into a budget. So you need to make sure you're giving yourself a plan. Most people that come to me don't have a plan. I ask them, how much after-tax income do you need to have on an annual basis to maintain lifestyle? And people can't give it to me. All they can say is, well, I make this now, and so if you take my taxes out, I'll have this. They can't tell me what they actually need. So what I tell those people is, hey, here's a budget form, fill it out, get a really good idea, because people forget about the basics. Like, we have to paint the house every 3 years, or I have to pay for the, HOA fees that I forget about every time I do, don't do a budget. So really use a budget tool to back into what you're actually spending. And that way that will help whoever you're going to work with for retirement figure out what your cash flow need truly is after taxes, not before taxes, because before taxes is really subject to be a failing benchmark if tax policy goes through the roof like we're expecting it to. So you want to make sure you have a budget. But the final thing I will tell you besides the budget is make sure that you don't have an estate tax. And a lot of people think right now that they don't have an estate tax. But I have a lot of clients that have just a couple of $1 million, and I'm telling them by the time we grow this for another 20 years, you're going to have an estate tax. So if you and your family, you and your spouse together combined have more than $4 million combined, or if you have enough net worth that will grow for the next however many years to get to a $4 million residual, then I'm going to tell you as a tax lawyer that I am pretty sure by the time you pass away a couple decades from now, you will have an estate tax. And so you need to make estate tax plans. The government is keeping the number really high right now. It's almost 24 million for 2 people in 2021. But this administration has already said they want to cut that from 24 million to 8 million, $4 million a person. So don't get in the trap of not believing that you need to do any estate tax planning because the numbers are so high in 2021. Do not fool yourself. They are reverting automatically back on January 1 of 2026. So I think that pretty much does it. Let's just summarize. Look through your total accounts for any positions that you no longer want to hold that have losses. You can harvest those losses by selling out and applying those losses against your gains. That's just simple basic tax loss harvesting. Make sure you have done a budget and you know what your cash flow needs are. Ask your corporate HR department if you guys have a Roth 401k, and if you do, seriously consider redirecting your annual contributions to your 401k to a Roth instead, because taxes can only go up in the state of America that we have. And finally, if you do have RMDs and you want to make charitable donations, consider donating appreciated property where you can get the full fair market value as a write-off up to certain limits of your AGI, and not have to pay the capital gain. So that's a double positive tax whammy that we love to take at the end of every year. And the last thing is, if you have an RMD, make sure you take it because you want to avoid the 50% penalty, but definitely consider a QCD, a qualified charitable distribution, as opposed to an RMD. It will count as your RMD, but you will not have to count the income. And that will also reduce your taxes. Other than that, let's just deal with this almost 7% inflation that we have. And until next time, you guys have a great week.